Since price has essentially remained flat after the March 5th gap down, we can reuse the Fibonacci channel from last time with default settings and adjust the time zone tools to these positions, then point a Fibonacci spiral up from the March 19th lows. In summary, even if there can be solid contact with 770, further progress with an upswing would still likely slow down, reaching the gap fill and the top of the channel. During this next approximate interval, even if volume were to go closer to 80 million. On the other hand, if it's just more of the same, price can hold neutral to bearish to continue pressure for entry down into the $6 range. That could be possible even with daily volume closer to 50 million due to the longer-term bearish advantage. On the next chart, selling was also exhausted but without a gap down, leading to a temporary pause and a minor bullish retracement with just above average volume. And over the last week, some natural resistance around the $2 boundary. With a long-term downtrend, we can still reuse the same Fibonacci fan from last time. Then a pair of regular Fibonacci time zones at these positions. And like the last chart, we can also add a Fibonacci spiral pointing up from the most recent lows. Crossing back over the $2 boundary would still likely need daily volume at or above 10 million. Then the chart would need a solid close over the spiral and 245 for a more significant long-term reversal. Continually being repelled back under $2 can improve conditions for falling under the moderate 177 level, which is much weaker in the broader context compared to the 150 to 130 range. Then Microstrategy stock just barely fell short of going over 2,000. So it followed the extension spiral to retrace back down to the low 1,000 range, which still offers major long-term support potential. To learn more about Fibonacci techniques, chart patterns, indicators, and other technical analysis topics, please stay tuned and subscribe, and check out the hundreds of tutorials already uploaded.